Welcome to our in-depth analysis comparing Cornwall and Devon for holiday let investments. Today, we will explore which of these two popular regions presents a stronger opportunity for potential investors. Both counties offer unique advantages, but for an investor, the numbers tell the real story. We'll be using the Holiday Let Investor platform to walk through these scenarios. Before we begin, it's important to clarify that this is not a travel comparison. This is about the business of holiday letting. Both Cornwall and Devon are well loved for their stunning coastlines and established visitor demand. They are world-class destinations with proven track records. Here, we aim to provide an analytical breakdown of investment opportunities, focusing on factual data rather than personal preference or holiday memories. When considering holiday let investments, it is crucial to examine several key factors that drive long-term success. First, the purchase price. This is the foundation of your yield calculation and determines your entry point into the market. Next, setup costs. From furnishing to regulatory compliance, these initial outlays impact your total capital requirement. Then we have income evidence. We move beyond estimates to look at real-world booking data and comparable property performance. Seasonality is a major driver in the UK. Understanding occupancy patterns across the year is essential for cash flow planning. Your management route, whether you're hands-on or using a full-service agency, this choice fundamentally alters your cost base. Running costs, from utilities to maintenance reserves, we must account for every outgoing before we can calculate net returns. Finance pressure. With current interest rates, the cost of debt is a critical variable in your monthly cash flow. Break-even occupancy. How many nights do you actually need to sell to cover all your costs? This is your safety margin. And finally, downside scenarios. Stress testing your model against market shifts is what separates a gamble from an investment. Understanding how these elements interact can greatly influence your investment decisions and long-term portfolio strategy. Let's illustrate these principles with two hypothetical examples from our platform's comparison engine. Example A is a Cornish property priced at £425,000. It's a high-demand coastal cottage with significant appeal. We've forecast a gross income of £52,000 for this property based on regional performance metrics for similar-sized units. Example B is a Devonian property with a lower entry price of £375,000, a different value proposition in a highly desirable area. For this property, we forecast a gross income of £44,000. It's a slightly lower headline figure than the Cornish example. Both properties assume a 25% deposit and interest-only finance, which is a common setup for many UK holiday let investors. We've used an illustrative interest rate of 6.25% for these models. This reflects current market conditions and serves as a baseline. It's important to note that higher gross income does not necessarily indicate a superior investment. We need to look deeper. To make informed comparisons, we must scrutinise the underlying demand and seasonality of each location. For example, A, in Cornwall, our data points to 190 booked nights across the year, representing a strong seasonal performance. This is achieved at an average nightly rate of £274. Higher rates often correlate with peak summer demand in Cornwall. In contrast, example B in Devon shows 180 booked nights, a slightly lower volume reflecting a different regional occupancy curve. The average nightly rate here is £244. While lower than Cornwall, the entry price of the property was also significantly lower. It is critical to evaluate whether these figures stem from verified historical data or are simply broad regional estimates. Always ensure you are comparing similar metrics and data sources to maintain the accuracy of your investment case. Next, let's delve into running costs. This is where many investors overlook the true cost of doing business. For the Cornish example, we factored in a 22% management allowance, typical for full-service agencies in prime coastal areas. Total running costs, including cleaning, laundry, utilities, and maintenance reserves, amount to £30,970 before any finance costs. Conversely, the Devon property operates with a 20% management fee, reflecting a slightly different regional market structure. This leads to lower overall running costs of £26,010. Every percentage point in management fees impacts your bottom line. Your choice of management style, self-management versus agency management, significantly influences your total costs and time commitment. What does this mean for your actual cash flow? Let's walk through the gross to net logic for both properties. Starting with Cornwall's gross revenue of £52,000, we begin our deductions to find the true net income. After deducting the running costs we just outlined, we arrive at a net income of £21,030 for the Cornish property. Meanwhile, Devon's gross revenue of £44,000 undergoes the same rigorous analysis. The Devon example generates a net income of £17,990. The gap is closing when we look at net figures. When we account for financing, Cornwall's total interest expense is £19,922, which is a significant monthly outgoing. This leaves a final cash flow of just £1,108 for the year, a tight margin for a property of this value. For Devon, the finance costs total £17,578. Because the purchase price was lower, the debt service is more manageable. This yields a final cash flow of £412. While smaller than Cornwall, the relative entry cost was also lower. This highlights a crucial lesson. Higher gross income does not necessarily equate to better cash flow for the investor. Now, let's stress test these models by simulating real-world volatility and downside scenarios. We'll simulate a 12% decrease in gross income and an 8% increase in operational costs simultaneously. We'll also model a rise in interest rates to 7.5% to see how the financing costs impact the safety margin. Under these conditions, Cornwall faces a negative cash flow of minus £11,594. The sensitivity to income drops is high. Devon also enters negative territory with minus £10,465. Both models show the importance of having a robust buffer. The stress scenarios illustrate Cornwall needing about 223 booked nights to break even, while Devon requires about 215. These findings should not lead immediately to a purchase offer. They are the start of your due diligence. Develop an evidence-based checklist before committing. Review booking histories and assess assumptions about cleaning and utilities. Understand the specifics of management responsibilities and plan for regular maintenance contributions and inspections. In summary, this analysis of Cornwall versus Devon underscores the absolute importance of informed, data-driven decision-making. Rather than selecting based solely on geography or personal appeal, focus on the robust investment case each location presents. Investing successfully requires careful analysis of these considerations and the current data available to you today. As you navigate your research, remember to utilise the tools offered by Holiday Let Investor to model the assumptions we've outlined today. If you need more Holiday Let calculators, guides and deal checking tools, visit holidayletinvestor.co.uk.